All right. If you're serious about investing, you need to know about public.com. That's where you can invest in everything: stocks, options, bonds, crypto. They even offer some of the highest yields in the industry, like the bond account's 6% or higher yield remains locked in even if the Fed cuts rates. What sets Public apart is how they give you the tools you need to make informed investment decisions. Their built-in AI tool called Alpha doesn't just tell you if an asset is moving, it tells you why the asset is moving, so you can actually understand what's driving your portfolio's performance. Public is a FINRA-registered, SIPC-insured US-based company with a customer support team that actually cares. Bottom line, your investments deserve a platform that takes them as seriously as you do. Fund your account in 5 minutes or less at public.com/investing unscripted and get up to $10,000 when you transfer your old portfolio. That's public.com/investing unscripted. Paid for by Public Investing. Full disclosures and podcast description. Hey everybody, welcome back to Investing Unscripted, where we ask and answer the hard questions about investing. I'm Jason Hall, joined by my good friend Jeff Santoro, the voice of the people, who I have to say, so far in 2025, Jeff, you've been on every single podcast with me.
I have a nice streak going. I plan on keeping it going.
Good. Me too. Unless somebody better comes along.
Look, we already know who that better person is.
Yeah.
So consider me warned. Warned.
Let's be honest. I'd be the one out the door before you.
Yeah, I know. I was just being polite.
Yeah. Yeah. Definitely not like your normal self.
I'm trying something new.
There you go.
I'm being polite.
There you go. All right. You and your New Year's resolution. All right. Now that we've gotten that silliness out of the way early, Jeff, today's concept, despite the fact that you came up with the idea, it's a pretty good idea.
Thank you. Well, you came up with half the idea. So the listeners should know that my idea was to do an episode about learning the wrong lessons. And then your idea was to pivot a little bit more towards investing myths and maybe disproving some of them. So we just decided to mash the two together and call the episode Investing Myths and Learning the Wrong Lessons. Super creative. We're nothing if we're not creative, Jason. But regardless, I think this will be a fun conversation and we can dispel some myths, but also talk about lessons we've learned, but then also like what could have been the wrong lesson to learn from those experiences. So we'll see where this goes. It's unscripted.
Yeah. And I think there is a Venn diagram here where the two overlap, because you have these tropes, investing myths, and we'll talk about some of them where people learn them and you're learning the wrong lesson behind kind of the underlying thing there. So I'm excited to have this conversation. Like you said, it's probably going to be more on the unscripted side of what we do. But before we do that, I want to read a note we got from one of our listeners.
Okay.
You're killing me here, Jeff. As everybody knows, our mailbag episode was last week, and we get questions throughout the month. I want to say people have really kind of stepped up getting those questions to us, not just waiting for the call out, but sending them whenever you have them. And this is a question that we got from Gorsk 4023. And the short version of the question is, Gorsk was thinking about trying to reduce exposure to the Magnificent Seven, looking at market valuations. And the overall question is, am I being smart or am I being dumb thinking that I'm being smart? And Gorsk's response, we spent a good bit of time going through this one. And Gorsk's message to us was, thanks guys for the thoughtful response. You didn't answer it, but you absolutely helped me think about it in more depth. And that, I think, kind of gets at the core of a lot of what we're doing. There are times where we can give an answer that's just like a clear answer about how we think about something. But when it comes to some of these bigger topics, Jeff, kind of helping like think through it and then apply your thought process to finding the right decision and right answer for yourself. That's really what we're aiming for. So hearing that from one of our listeners, to me, I really appreciated that feedback.
Yeah, no, that's great. I mean, what I find is out there in the financial media space, if you want to put us in that bucket, is people who legitimately can give financial advice and do, and people who shouldn't and do. And yeah, we don't want to be in either of those two camps. So we'll talk through ideas. We'll share what we're thinking. We'll give some other ways to think about it, and then y'all got to figure it out. So yeah, but thanks for that note, Gorsk. That's appreciated.
I think the part that you'll probably appreciate the most was that Gorsk made a point to say, and I quote, "Even Jason helped."
Yeah. No. Now, and what we did say last week on the mailbag that your best bet to get anything read on air by us is to make fun of one or both of us. So he's a smart man.
I submit this to the court as evidence. The other thing too, get your questions in now, get your comments, things you'd like to Whether it's something you just kind of want a binary, here's an answer for it, or you want us to maybe talk about how we approach or think about something like that, please keep those things coming in. I think that's fantastic. Okay, on to the show.
All right, let's dive in here. All right, I'll let you choose, Jason. Would you like to start the conversation with either an investing myth or a learning the wrong lesson example? I'll leave it to you.
Well, I mean, at this point, Jeff, we're already playing with house money. So,
So bad.
yeah.
All right, let's talk about house money. It's ironic that you put this on the list because just today, I don't even know who it was. I was on Blue Sky just scrolling through posts and someone made this exact thing, like about selling something because of house money, and someone like reposted it, and their only response was, there's no such thing. It's all your money.
It's all your money. Yeah.
So
Yeah. So we hear this all the time. And essentially what people are generally getting at is like if a stock is doubled, the idea is, okay, I'm playing with house money at this point. And it frustrates me to no end for a lot of reasons. The obvious one to me to start with is the gambling connotation, where you're risking money on binary outcomes on a regular basis when you're gambling, right? And the idea of house money is cool, right? You walk in the casino and you're there with some buddies for a weekend trip and you're like, okay, I have $300 that I'm going to risk. And you walk up to the blackjack table and you end up with, $600 right there. It's like, sweet, I got my $300 that's going in my pocket and I get to play with house money for the rest of the weekend, right? That's it. The difference with the way that we think about, Jeff, you and I, and the way probably the majority of people that listen to this think about it, is when with investing, it's only gambling when you're talking about short periods of time, and when your ability to outlast downside volatility is shorter than the market's ability to be volatile to the downside, right? Then it is gambling. That's why we talk so much, and why I've learned that you can't risk money that you're going to need in the short term. In the short term, I mean, really anything 5 years or less, because what happens is when you invest money in the stock market, you no longer have money. You have stock, right? You own an interest in a business, and we use money to value whatever it's worth based on what the market thinks it's worth on any given day. And you bought that business, you invested in that business on its ability to pay you a dividend, get more valuable, right, over time. Like that was the thing. Whatever happens from there, if the thesis plays out and the stock goes up and gets more valuable, it's never house money. Okay. I know I'm not supposed to use the F word on the podcast. I promised a listener about a year ago, but sometimes it's the word that makes the most sense to use. And it's not house money. Okay. It's not even money at this point. You bought a business and it got worth more money.
Yeah.
Yay, you. Okay. There is no house. There are a lot of participants in the market, and you hedge against that risk just by owning it over long periods of time. Now, yes, at some point, the dollar value of that particular investment may get to a point where it's so large, then you are starting to risk your long-term financial future by not turning some of it into money and selling it. But the whole idea, because what happens, dude, is people they build these entire investing frameworks on this nonsense. And it becomes not even a framework. It's just a rule. It's like a stock doubles, I sell half of it, right? A stock goes up 50%, I sell 25% of it. What does that even have to do with anything? Because it doesn't have anything to do with the quality of the business. And I'm rambling here. You should,
I'll cut you off.
Let me get off the soapbox.
Well, you brought up a lot of really good points. What it makes me think about is the idea that I like that you separated it. And I like that you made the clear distinction between the gambling use of the phrase house money and how it gets conflated in investing. And I think the reason that happens is, as much as we say it, and honestly, you and I are probably at times guilty of this even ourselves, which is forgetting that you own a business. And I think, just kind of put it in more realistic terms. Like, let's say your best friend from high school opens a coffee shop in your town, and you believe in this person, you've known them your whole life, you think they're great, they're super smart, they're hardworking, and you say to yourself, I'm going to give my buddy, whatever, pick the dollar amount, but $50,000 to help him get started, and I'm going to own, 10% of his business. If 5 years after that,
I better own at least 25% if I'm giving him 50 grand.
Okay, I'm just picking random numbers here, this is to illustrate an example, but thank you for interrupting me. If 5 years later,
economics matters, Jeff.
If 5 years later, that coffee shop is doing, 6 times the revenue it did when you invested, you wouldn't be like, I don't care about this coffee shop anymore. It's house money. Like you would, because it's your buddy's coffee shop, right? And I think you have to, it's very different because we all own, imperceivably small amounts of these companies, but it is important, I think, to just think of it in that same framework. You wouldn't view your buddy's business like that. And I don't think you should view owning Apple stock like that, as an example. Yeah. And you're right. There are people who build whole frameworks around it. Like you said, it doubles, I sell half, all that stuff. And who knows, maybe there are people who can make that work, but I would love to put their returns up against someone who just bought a great company and held it for 35 years and watched it 10x. Because I have a feeling I know who's going to make out better in that scenario. So,
well, it's obvious, Jeff, because here's the bottom line. Think about it. It's really hard to find a stock that doubles. A stock that doubles. If you find a stock that doubles and you sell half of it every time because that's your process and you're going to cash out that your investment, and then the rest of the investment is the quote unquote house money. Now, what do you have to do? You got to go find another great stock, right? So when you give yourself a haircut every time you're trying to grow a ponytail and it gets to a certain length, you're never going to be able to have a cool ponytail, right?
I'm not sure on a guy. I don't think a ponytail is ever that cool, but maybe that's just me. No offense to our ponytail listeners out there.
Why does it have to be a guy?
Maybe I'll cut this out because I think ponytails look fine. Never mind. I'm cutting all this out.
I'm just going to put it back in because I do the final edit.
Okay, so that's a good.
It's obvious what's happening with people that are investing, and this is part of their mechanism for doing it. You're absolutely going to get worse returns because finding winning stocks is so damn hard. If you sell half the investment every time it doubles, you're constantly punishing your portfolio for you making one smart decision.
Totally agree. All right, let's go to another investing myth. I don't know how much this is a myth, Jason, but just a thing that I think people think is the right thing to do, but we should dispel it. And that is selling as soon as there's a short report on a company that they own. So let's talk through that.
Yeah. So I don't think this is one that's super common, but it's more commonplace than you might think. And the evidence is what happens when a well-known short drops a write-up, their research or a report about a company that they've already shorted. They generally, almost always, they fall, sometimes pretty substantially. And there are investors that anytime, and I think we can build on it being short reports too. You see the same thing happen on analyst downgrades, where people have part of their process. If an analyst downgrades a stock, okay, I'm selling, right? And as a starting point, when it comes to shorts, I think that short selling and short sellers is an important, healthy part of the market because you need buyers and sellers, right? And I'm not saying that I think some of the unethical and in some cases illegal behavior that we've seen proliferate more over the past really 10 years or so. I'm not saying that I support that because market dynamics have certainly rewarded a lot of people that have had a little bit of success and then built enough of a following around that their incentives are entirely tied to creating some downside action in a very short period of time, right? Where they profit and then they close their short and move on, and you never hear them talking about that company again. So the lesson is, if you look at most short action, the long tail after short reports come out, the majority of the time the company goes back to deliver the sort of returns that it had in its prior existence, right? There are notable exceptions when the short is about a company that actually has fundamental flaws, obviously. But I think the point is that people that follow this process are running from a risk that is actually exposed just such a small fraction of the time that it's just an error of noise when shorts actually tend to find something.
Hey everybody, we'll be right back, but first a word from our sponsors. FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company-specific segment and KPI data on around 1,800 stocks. So for example, do you want to see NVIDIA's data center revenue growth? They've got it. Do you like to track Apple's iPhone sales? They've got that too. Or how about nights and experiences booked for Airbnb? You guessed it, they've got it. And they just added around 8,000 ETFs and mutual funds to the platform. The breadth of FinChat's data is truly one of a kind. I use FinChat every single day as I'm researching the stocks in my portfolio, specifically when I want to see how they're doing on KPIs that FinChat is famous for. So to get 15% off any paid plan, go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes. Hey, Investing Unscripted listeners, this episode is brought to you by our friends at Yellow Brick Investing. Yellow Brick is an aggregator of the best stock pitches across the internet. By tracking thousands of blogs, newsletters, fund letters, podcasts, and more, they're able to collect and summarize the best stock pitches from all over and bring them to you in one single place. Think of it like a modern value investors club. I have to say, this is pretty cool. I can just type in the company I'm interested in and get a bunch of different stock pages from across the internet. It helps me think through new ideas and find opposing points of view on the stocks I'm interested in. And the best part is access to Yellowbrick is completely free. Try it for yourself. Simply go to joinyellowbrick.com and search a company or ticker you're interested in. You're bound to find a great report on just about any company. That's joinyellowbrick.com. I have to be honest, I struggled with this. I think the only time this happened to me where I owned a company and a short report came out was what I used to own Block, which has now changed its ticker to XYZ, by the way, Jason. I don't know if you caught that.
Yeah.
And in March of 2023, Hindenburg Research, which it was in the news recently because the guy who runs that has just ended it.
They're folding up shop.
But
yeah.
That report came out and I had already kind of started to sour on the stock a little bit, if I'm being honest, mostly because I just didn't like Jack Dorsey and just the decisions he was making and his whole vibe. And I thought he made some weird decisions like acquiring Tidal, Jay-Z's streaming service, and his obsession with Bitcoin, which maybe in retrospect turned out to be smart, but put that aside for a second. But I struggled with this because like I knew enough about short reports to know that exactly what we're talking about. Like I should not rush out and sell. It did drop a double-digit amount when the short report came out, if I remember correctly. But I just looked up the stock chart since the close of the market, the day before the short report came out to today, the stock's up 20%.
Yeah.
So had you just, read it, taken it in and decided to hold, it would have been fine. And by the way, it would have only taken until about January of 2024. So about 6 months to get, sustainably back to well, I shouldn't even say that. It did dip below again, but like just to kind of get back where it was. So like, I understand why it shook some people out. It fell, it went up, it came down, it went up, it went down a lot, but that was just other reasons, I think. So yeah, I think like we talk a lot about, it's a framework kind of a thing and not a rule kind of a thing. Like you should have some way of handling short reports. I think if you own a company and one comes out, you should certainly read it. You should see what the company says in response. You should use it as a way to poke holes in your thesis. But a rule where this happens and therefore I will do that, I don't think is wise.
Yeah, and I understand in limited cases for some investors why they do this. When you have investors that maybe run pretty concentrated portfolios and maybe they're using that portfolio for like today income or something like that, and they want to make sure that they're avoiding any further downside risk in the very near term, I can kind of understand that, but there has to be more than just you sell and you're done, right?
Yeah. This is also, we can actually tie this into the second idea of the show, which is learning the wrong lessons. If you invest long enough and have a broad enough portfolio, this will happen to you. There will be a short report on something that you own. And I could absolutely see, if you read the short report on Nikola and then sold that, I think after that, like you might learn the wrong lesson of, every time there's a short report, it's going to go to zero. Same thing with short interest, by the way. Like just having a lot of people who are short the stock could just mean that people think it's overvalued, not that they think it's a fraud that's going to go to zero. So there's also a wrong lesson you can learn in a sample size of one when a short report turns out one way versus another. All right, here's another myth that I hear out there. And I hear this one mostly from people who are, I would say, risk averse. So, they know they should be in the stock market to some degree because that's the way you build wealth for retirement over a long period of time, but they only want to buy what they conceive as the safest stocks and nothing risky. Let's pop the investing myth that you should avoid risky stocks entirely.
Yeah, I think where it kind of starts is there's a lot of misconception around what risk really is. And a lot of it is volatile stocks are considered risky stocks. And it gets back to the idea that one of the best ways to inoculate yourself against volatility risk is your capacity to hold. That's number one, right? And it's your financial capacity, but also your intestinal fortitude. Right? It's both of those things. And a lot of that intestinal fortitude is built on knowledge of the business and the industry and just the mechanics of the stock market, right? The fact that people are voting constantly on what they
But it's also, I would just add to that and then you can continue. It's also a way to inoculate yourself against it even further is to make sure that you have a diversified enough portfolio that any one stock is not going to bankrupt you.
Right.
Because you can have all the fortitude in the world, but if your entire net worth goes to zero, it ain't no fortitude going to get you through that.
I mean, think if you've got 5% exposure to a company, for most people, 5% is a pretty big exposure, right? But from that same idea, having a company that's worth 5% of your portfolio going bankrupt, you still have 95% of your invested wealth, right? Yeah, it's going to leave a mark, but if you have 95%, you're probably still going to be completely fine, right? You might have to make some minor changes, and I think that's the point of those ideas, right? Diversification, capacity, and capability to hold through those downturns, but also just having some fundamental understanding of what real risk is and how you can manage that. So, for example, for a long time, people would consider tech stocks to be risky as a category. And in 2021, there was a lot more risk than there was in 2022 when the market bottomed. So valuation matters a tremendous amount, even for companies that have high capacity for growth and are still early in their growth phase. You combine valuation with position sizing, and that's a great way to manage for risk while still having the capacity to get gains. Because the inverse of this, Jeff, is I see this happen all of the time during periods of uncertainty where you see blue chip stocks, businesses that are viewed as being super safe, lots of investor capital flows into those stocks at high multiples, right? They keep getting bid up, and people are like, this is safe. I'm never going to lose money here. This is where I need to be. And then what happens is people manage to not lose money in an asset class that the goal shouldn't be to avoid losing money. The goal should be to compound your wealth, right?
It's funny because I think when I was a newer investor, it was easy for me to consider a risky, to know what a risky company was under one definition of a risky company, which is like, okay, this company is small, it doesn't have a lot of revenue, and it's in, it's either going to change the world or it's going to go to zero. Like I see it as like a binary outcome, right? That's easy to identify as a risky company. But like a blue chip stock that's been around for 100 years, that is cash flow positive, and pays a dividend and has, good earnings growth year after year after year, safest of safe in a lot of people's eyes. If that company gets bid up to 60 times earnings and you buy it that day, that's in my mind riskier than taking a bet on that small binary company. You know what I mean? Like, cause your chances of making money from that lofty amount, even though it's a stable company, might be lower than your chances of making money on that quote unquote risky small company. Right. So
no, that's exactly right.
There's different ways to think about risk.
Yeah, no, that's, and this is so important. I just want to lay out the mechanics of this for anybody that doesn't think about it. If you pay 35 times or 40 times earnings for a company that historically has traded closer to 20 or 25 times earnings, and it's only growing earnings per share in the mid to high single digits, it's going to take years when that stock eventually reverts down to its long-term valuation mean, which it will, because they always do. It's going to take years for that company to grow back into the price that you paid for it. And a lot of times what we see, Jeff, is we don't see these big down. It's, the stock starts here, and then over a period of 3 or 4 or 5 years, it just kind of bleeds you to death. And the next thing you know, you're down 5 or 10 or 15% over a few years, and you were expecting to hold your value and get your nice little 2% or 3% dividend yield. And it doesn't work out. Right? It doesn't work out. And sure, maybe you didn't take a bath, but you end up in worse shape than you were. Even if the stock mostly goes sideways, your spending power has been eroded because the dividend is probably not going to be enough to offset inflation. This stuff really, really matters. I mean, valuation, when it comes down to it, matters more for the big stalwart blue chips that people buy without even thinking about price than it does for the high growth companies that people get caught up on in the valuation.
Yeah. I mean, a good example of this is, I don't know. I don't know. You tell me if this is a good example. I don't know how many people viewed Microsoft as being risky in the 90s. I think by the time it had gotten bid up to its high back before the dot-com bubble, it was probably viewed as a good, stable company that had been around for a while. Everyone uses PCs and Windows and all that. It wasn't like it was a tech startup. How long did it take for Microsoft to get back to its, I don't know, the year 99, 2000 high, like 15 years, right? And that's right now. I don't know, it probably less so back then, but now that's considered to be like a pretty stable blue chippy type tech company, right? I'd say out of the Mag 7, maybe they're the blue chippiest, I don't know, they've been around for so long. They're so big and established. And, it's not like it was a $2 billion, not even like a $500 million tech startup when it hit that all-time high. So that's an easy example to look back on. Hey, everybody, we'll be right back, but first, a word from our sponsors.
All right, if you're serious about investing, you need to know about public.com. That's where you can invest in everything: stocks, options, bonds, crypto. You can even earn some of the highest yields in the industry, like the 6% or higher yield you can lock in with a bond account. Public is a FINRA registered SIPC insured platform that takes your investments as seriously as you do. Fund your account in 5 minutes or less at public.com/investing unscripted. Get up to $10,000 when you transfer your old portfolio. That's public.com/investing unscripted. Paid for by Public Investing. Full disclosures in podcast description.
Investing Unscripted is brought to you by the Chit Chat Stocks podcast. That's right, another investing podcast you need to add to your listening rotation. My name is Brett, one of the hosts, and I produce 2 episodes weekly along with my co-host, Ryan Henderson. On the Chit Chat Stocks podcast, we talk stocks, a lot of stocks, from the hottest names to undiscovered gems, interviewing sector experts, studying super investors and why they are successful, and we have a fun time while doing it. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts, and never miss an episode.
All right. We've talked about this one a lot, so maybe we won't have to spend a lot of time on it. But another myth/thing that I think people think differently about is the idea of doubling down on a stock that has fallen.
Yeah, this is one that drives me absolutely crazy, and it's tied a little bit to the next thing that we'll talk about here. We see investors generally are very reactionary. Broadly, I think that and again, this is just my guess, but I'm thinking the data would probably back it up. The vast majority of individual investors who are buying and selling stocks are reacting to what the stock price is doing, and that's determining their actions. And I'm guessing it's probably an order of magnitude more than they're actually doing any sort of fundamental research, right, to decide what to buy and sell, when to buy and sell. So like a lot of people, this is just what they do. If they buy a stock and it falls, they buy more, right? The idea of trying to average, and it sounds smart. I'm lowering my cost basis. I'm averaging down on this, and without putting any credence into why, right? What's going on with the business? Was it a mistake to buy it at the higher price? Why was it a mistake? Why is the stock falling? What's going on with the business? What's happening in the industry? What are the puts and takes of the economic environment that might be affecting it? The cycle for the industry that it participates, like all of that stuff. There's just no credence paid to it all. It's like, I'm just going to buy more of it. And then you know what they do? They say, and as soon as it gets back to where I bought it at, I'm going to sell. When I get all my money back, I'm going to sell. And it's two dumb things, right, Jeff?
Well, but here's why this is really a lot harder than it sounds. Everything you just said is true, and it's also false. So like you just laid out the scenario of you buy a stock, it falls. You say to yourself, I'm going to lower my cost basis and buy more. And you make, and you're right. If all those decisions are driven by nothing other than the stock movements, put that on the bad column. But you could make the exact same series of decisions, and they could be really smart if there is a clearly defined why behind all those decisions.
Yeah.
Right. And I think that's the distinction. That's why I think it's something that like people fall into the trap of, because, we both try to buy up, not average down, right? To steal David Gardner's line. And it makes sense because, I say this all the time, like pick Apple's stock chart and go back more than a year from now and just pick like any point along that spot and say, if I had bought here, and you would have done fine, right? And that's a stock that has generally gone up for its entire existence, right? I mean, obviously there's always dips, but over the long span, it's up and to the right. But it's also okay to find a stock you have a lot of conviction in, that you think is executing really well, that is either in a short-term rough patch or the market seems to not be giving it credit for something that you think it should have credit for, and double down. I bought this stock, it's down 40%, but I still believe in the company for these specific reasons. I'm going to buy more. Can actually be a really smart decision.
Yeah.
I bought a stock, it's down 40%, I'm going to buy more, and that's the end. Could be a bad decision, right? So I think that distinction is tricky and important.
It's massively important. And I will tell you a time that I think, I'll give you 2 examples of when I think the business focused averaging down really, really works. When you have a stock that you are really interested in, you're really compelled, you don't own any, but you know your psychology enough to know that if you just take a small starter position, you're actually going to pay attention. You're going to track the stock price more. You're not going to, it's not going to get lost in the shuffle, right? Even if you realize I'm probably just paying too much. I think it's caught up in momentum and I think something's going to happen. Taking that small little nibble to get skin in the game to get some, to be psychologically bought into, not just to be actually bought in, it can be really powerful because you're going to see that signal of the price coming down. You're like, oh yeah, that's kind of sucks, but I figured this was going to happen. Let me start figuring out the why. Like, okay, everything's the same, just the market's coming back down to earth. And then you start fully building out that position, right? So there's also just the reality. This is the second one. I've got a third one too, but the second one is being able to say, you know what? I paid too much. I still like this business, but I got caught up in what was going on and I paid too much, right? My expectations were wrong, but then determining that you still like the business, right? And acknowledging that you were wrong about the price you paid, but seeing the business is still being worthy of investing more in, right?
Yeah. I mean, look, anything I bought in 2021 would fall into that bucket.
There you go. Yeah, there you go. Right.
Right. Like if I never quote unquote doubled down, I would not have added to any position of a stock I bought in 2021 because everything was too expensive in 2021. So yeah, there are times to do it.
And this is getting us into learning the right lessons versus learning the wrong lesson. Mm-hmm. So the wrong lesson for investors that bought in 2020, part of 2021, and then saw their portfolios get smashed and sold is the stock market's rigged. It's too risky. I can't, and then never investing again. Right.
Yep. I mean, I've told this story multiple times, but I'll tell it again about my family member who owned less than 10 stocks back in 2000. One of them was Cisco, another story of a stock that has never recovered price-wise. Cisco hit a high of $80 in early 2000-ish, and it has never come anywhere close to $80. It is currently at 61, and it has not been above 64 in 25 years. So the lesson this family member learned was I shouldn't buy stocks. The lesson they should have learned was I shouldn't have only 3 stocks.
Right. I shouldn't have only 3 stocks, and I shouldn't base my decisions on one thing that happened at one of the market's all-time valuation peaks.
Right. Perfect example of learning the wrong lesson. All right, let's switch gears here a little bit. Maybe we can come back to some myths if we want to, but I want to let's dive into some actual other wrong lessons since we just talked about one.
I want to tell you this. This is cool. You'll appreciate this.
Okay.
So Cisco's stock price is still down about 23% from its all-time high, but it pays a dividend and the yields actually come up and they've been able to grow the dividend. In the past week, it's actually managed to get back to 0.
On total return?
On total return. Right.
Well, I'll let my family member know that they shouldn't have sold 25 years ago.
Yeah. No.
If you just held on for half a decade, quarter of a century, that's what I meant to say.
You would still have less spending power than you did.
Yes, because we are not adjusting for inflation.
Right.
In that scenario. So now I'm going to play everyone's favorite drinking game where I talk about Outset Medical, but I'm going to combine it with Moderna. And I'm going to tell a biotech wrong lesson learned story. So I put these two in the same bucket in my portfolio because they are biotech/medical device companies that I was interested in 2021 and in 2020 when the market was overvalued and they were doing things that were not going to turn out to be sustainable. And I bought them both and I don't regret buying them. I don't regret still holding them. Honestly, I really don't. But the mistake I made, and I think the wrong lesson was not the buying decision, but it was the lesson I should have learned was to not let my excitement about the potential and the story of these companies, like me being excited for like what I think they can do for like the world, to let that drive my investing decisions. Because the mistake I made was to put too much money in them too fast.
Yeah.
I probably should have been a little slower. And I remember doing it. And it was like, I really like this company. I'm going to go for it. Like that was sort of my vibe.
Right.
Now,
and because of recency bias, you're looking around and everything's going up. Like you immediately extrapolate that going forward. Right.
Right. But that's the lesson I did learn. The lesson I could have easily learned, and I think it's related to the Cisco story, is I shouldn't ever invest in biotechs or medical device companies, or I should never invest in a company that I like the story of.
Yeah.
But that second one, just avoiding companies where I like the story, would make me a sad investor because I like owning companies that I'm excited about, right? That's fun. That's part of the fun for me. I want to own a company that's going to do something good in the world and make me money, preferably do well and not drop 90%. Like those are my goals. But I think when you buy a stock that doesn't work out, the wrong lesson is just like to not buy stocks or that kind of stock or that. I think the right lesson is like, go figure out why, like what was the wrong thing? Did you misread the future prospects? Did you put too much in too soon? Did you not understand the company? Like, rather than just, oh, I should avoid that now. Kind of back what we said earlier about avoiding risky stocks.
Yeah, and this is one of the things that when we're trying to, do an autopsy on a bad outcome like that, it can be really hard to do it and to look past your motivations and the biases that you've built, right? Because you're a jilted lover sometimes with these sorts of things where you'll turn on a company that destroys 80% of your investment or more pretty quickly, or possibly even worse, develop Stockholm syndrome, right? and you start participating in their bad action by doing things like buying more, right? That averaging down that we talked about of a business that hasn't earned any more of your capital. But I think thinking through learning the lessons there, the one that resonates with me the most is the story stocks part, right? I mean, here's the bottom line. Like, if you just look at the history of the US stock market, how can you not find optimism? Because the fundamental driver of value that has created wealth for investors in the US stock market over the past century is the growth of earnings per share, right? Is businesses becoming more valuable, creating wealth, creating value for their customers and their shareholders along the way. And along that same ride over this past century, think about the improvements in quality of life, right? Think about how even people on some of the lowest economic rungs are able to do things without even thinking about it, like taking a shower, a hot shower, that the wealthiest people in the world weren't able to do, 75 years ago. So again, I'm not minimizing the realities of the number of marginalized people out there and the separation of how much more the wealth has accumulated towards the very highest, most wealthy people out there, and how even the middle class has lost some ground. But overall, the average quality of life that has been created by capitalism in the US stock market is enormously optimistic. So that underlying story is so powerful. But the key to me about it, Jeff, is the story stocks piece. You have to figure out what the numbers are behind the story.
Yeah.
It's that simple. And you have to understand a lot of, when it comes to disruptors, because story stocks are generally disruptors, what are the incentives that are disaligned that could blow up that story? So like we've talked about it with Outset, how the entrenched industry seems like it's been a real challenge for Outset to really disrupt that. In the same way that, do you remember the company Dermtech?
Yep.
Great idea. These little stickers for lesions on, instead of having
to test for skin cancer quickly.
Yeah, exactly. Instead of having to do a biopsy where, you're cutting out a piece of your face or whatever. The bottom line is dermatologists make a lot of money doing biopsies, and
not a lot of incentive for them to switch.
Right. So understanding those incentives for those sorts of disruptions is really, really important to me.
All right. I want to go in a different direction that we did not plan.
Yeah.
Which is
so here for
right
this.
in our wheelhouse. This is completely off the cuff. All right. So I'm looking through the stocks that I've sold, because what I do after I sell something is I just move it to another spreadsheet and I keep tracking it just to kind of see, like, was that a dumb decision? Was that a good decision? And I'm looking at some stocks that I've sold that are up.
You have stocks that are up?
That I sold. Yes.
Yeah. Well, that makes sense. Okay.
Like I'm looking at ones I sold that are up a lot, right? And I'm looking at some that I sold that are down a lot, right? So I'm looking at good decisions from a financial standpoint and bad decisions. But what's funny is I'm looking at, here's a stock that's up 162% since I sold it. And I don't regret selling it, because at the time I no longer, I'm trying to remember if it was down when I sold it. It was down when I sold it, but I was like, I don't want to own this anymore. I don't believe in it. I don't think it has a competitive advantage, and I sold it. So I'm trying to think about this through the lens of the wrong lesson versus the right lesson. And I feel like I did learn the right lesson, which was I owned way too many stocks over the course of my short investing career that I either didn't understand, didn't really have interest in, didn't care about, wasn't excited to follow, were too complicated, whatever the reason was. And I probably should have never bought them, because I looked through this list and I'm like, I don't want any of these back in my portfolio, even if I could go back in time and keep the returns. But I think the wrong lesson that I could have learned from all of this is anything I sold that went up was the wrong decision, and anything I sold that went down was the right decision. You know what I mean? And I think the reason I feel good about these is like I did it for what I thought was the right reason at the time, and I actually don't regret too many of these. So it's a little bit unclear in my head. I'm kind of speaking in draft form here, but I'm curious what you think about it.
Yeah, no, I think the key is that we buy stocks because we want them to go up generally, right? I mean, sometimes we buy them just for the income based on their dividend yield. But I think broadly, if you're buying a stock, the expectation is that it's going to gain in value, right? That's the payoff. And if we sell a stock that has lost money, we made a mistake to buy it in the first place. And if we sell a stock and then it goes up after that, it was a mistake to sell. And those things ignore the reasons and the motivations behind selling, which are not always as clean and simple as just, well, it's going to stop going up, so it's time for me to sell. Right? I've got a couple of examples that I can use. The most obvious one that in objectively on paper, without putting the messiness that's a human in their portfolio and their family and their financial goals and the timelines and all that stuff behind it, is when I sold half of my NVDA a couple of years ago. So the stock I'd owned it for a decade at that point. It was a massive winner. It had become the largest stock in my portfolio. And it's up like 4x since I sold. Right? It's become it in, I think it in Microsoft, or it in, what is it? Is it in Microsoft or in Apple? I think it in Microsoft kind of go back and forth between the most valuable company in the world, publicly traded company in the world. And then if you look at everything about AI, I'm sure you've seen the headlines here. We're recording this on the 22nd. Just in the past couple of days, this $500 billion of committed investment into AI infrastructure in the US. Man, when is this growth train going to stop? So from that perspective, yes, it's a mistake. But if you go and look at the reasonings that I had for selling it, it was making sure that I didn't end up in a situation where a stock that I bought to compound and generate a lot of wealth that had done that for me, that there was risk that I would begin losing that wealth, right? Because it had done so well. And for me, it made sense to reduce my exposure. And of course, like I said, I sold half and I kept half. The biggest lesson for me though was really, I made the decision to sell before I really invested more research and time into having a better fundamental understanding of what the next 3 to 5 years were going to look like for that space with the rollout of AI, more, infrastructure for AI. And it would have made sense had I done a little more research to wait a little bit longer. But again, I don't regret the decision, because I wasn't selling it because I didn't think it was going to keep going up. I was selling it because it had become a really big portion of my net worth. And I wasn't convinced that it had done enough for me, right? I had house money.
Yeah. So here's the other thing that's interesting too. Like, it's not as simple as when you do sell something, it's not as simple as seeing what it's done since you sold it. I think it's also worth seeing what it would still be if you kept it in your portfolio. So here's what I mean by that. One of the most recent companies I sold. So like in the summer of 24, I sold TWLO, and it was down for me a lot, which I'd be lying if I said that didn't contribute to my thinking at the time.
Yeah.
But the biggest reason I sold it was I couldn't determine its competitive advantage, right? Like it seemed like it had a product people liked, but making, the little app that you communicate with your Uber driver with on, the little communication box on the app doesn't seem like a non-replicable product to me.
Yeah. Where's the moat? Where's the economic
Exactly.
moat? Yeah.
And I was thinking about it a lot, and it was one of those stocks where I couldn't decide to buy more of it, double down, because I was like, well, maybe they'll turn it around, or just sell it, or just kind of hold and wait and see. So I ultimately decided to sell it. So it's up 112% since the day I sold it. But if I had kept it, it would still be down 57% for me from where I bought it.
Yeah.
So, financially, it was still probably the right decision. Like I would have saved myself, I don't know, $100 if I had waited. But think about how much time I would have spent freaking thinking about TWLO over the past year and a half if I had kept it in
I think
mind.
that's really important too, because for you, and you've talked about your situation where your portfolio of stocks is a relatively small percentage of your total invested wealth. And because you have a regular job, you have limited resources and time to dedicate to thinking about it. Your time thinking about stocks shouldn't be stocks that you're just not sure what's going to happen, right? Stocks that make up a small position of an already small part of your net worth, you are going to be better off dedicating more of your time to things you understand better and that you have more conviction in, right?
Yeah,
It's
sure.
It's just that simple. So whether it's just what happens with Twilio stock or not, the time that you've been able to dedicate to learning more about the things that you're interested in learning about will probably pay off with better returns over your investing career.
Yeah, agreed. All right, here's another learning the wrong lesson. You buy stock, like you don't really research it, you just buy it and it goes up, or you buy stock and it goes down. Luck or skill, right?
Yes.
Like there's always, I think that's a very commonly wrong lesson learned, especially if you start investing in a bull market or like a raging bull market, or if you start investing in a down market. Like I really thought when I started buying individual stocks, I was really good at this.
Right.
Because like
Back in
everything I
2020
bought
when
went
80% of stocks were going up.
yeah. I was like,
Yeah.
I wish I had discovered this sooner. I'm so good at this.
Yeah.
So I absolutely learned the wrong lesson starting at that point. Now luckily I learned it enough before the market went crashing down in 2022 to avoid even more mistakes. But
well, your wife reminded how much you suck at most things, and that probably
that's right.
helped
Yeah.
you.
I keep my confidence between you and I on these microphones and the dozens of listeners. I don't talk about this at home, but I think that's a commonly wrongly learned lesson, the whole luck versus skill thing.
Absolutely. I think it's like if you were to put a broad thing to think about to compare it, it's like the president. The president always gets credit when the economy is going good and by their own party, and blamed when the economy is going bad by the opposition party. And it's exactly the same for us as investors. If you buy a stock and it goes up, it's, oh man, I'm so good at this. If the stock went down, it wasn't anything you did, not your fault.
No.
The market did it. You got unlucky. I got unlucky. Something bad happened, right?
Yeah.
And we do that. Yeah, we do it. And that's normal. But like being able to like unpack what actually happened so that you can, number one, if it's something that worked really well and you can try to leverage like that, it's like, okay, this stock in this industry or with these certain characteristics that you found and like you did a lot of research and decided to buy on, okay, how can I take that and go find more of that sort of thing? Right? Not the next whatever, because it's horseshit when somebody says, the next Netflix or the next Amazon or the next whatever. There's never going to be the next of the same thing, right? Because they're just all copycats and they're going to be also rans. But it's like you found a company that had a really good return on invested capital, and like and now you understand the value of that particular metric, and now you can go find other companies that have a history of doing like high returns as well, and then apply that to your research process, right? So that's kind of how I think about it. And then if you made a mistake, the valuation was high. You thought they had a moat. You made the mistake of thinking that management was a competitive advantage when usually management are just perfectly adequate people that get lucky enough to run companies that have really good businesses, right? Not because they're necessarily special. That's not always the case, but I think most management is just they're mediocre and they're perfectly fine. They just their success is going to be tied to how amazing the business is, right? And their ability to not screw it up more than anything that's special about them that supercharges the business. Because you could take the best CEO in the world and stick them running a company in a crappy industry, and they're going to get mediocre results. It's, that's just kind of the reality of these things. So I think that's so important. I've got an example of one that it took me some time to really think through, like, what's the lesson here? It was a business called GT Advanced Technologies. They were a big supplier to the solar industry. One of the things that they developed was a synthetic sapphire. They would actually make these giant blocks of synthetic sapphire in these furnaces and then slice it really thin. And it was great for things like solar panels, screens on cell phones, because it's super durable, but also really, really clear. And it was a really compelling product. And they had some other things that they did as well. It was really interesting. It was kind of a small niche business, wasn't really that big. The growth rates were good because the solar industry was growing, that kind of stuff. But then the adaptations for using it for screens for electronics started to proliferate more as more companies were looking for the materials, right? The best materials, lightest, to be able to make it super thin, but also be strong enough, et cetera, et cetera, et cetera. They struck this massive deal with Apple. And it was a game changer. It was transformational for the business. Then they filed for bankruptcy. It was like on a random Tuesday. It's like, yeah, we're filing for chapter. I think it ended up going through liquidation maybe. It was ugly. And as we unpacked it, as the bankruptcy played out and the the documents started coming out, that kind of breaking things out, and some reporters, financial reporters actually started digging in and like really getting some of the details. The financial terms with Apple were like, and things that looked really good. It's like, Apple's like, yeah, our new manufacturing facility in Arizona. Yeah, you can just like, you can have this corner over here. You can have these, 25,000 square feet to make your Sapphire, right? Bring in your equipment and you can make your Sapphire here. So there were some, great advantages that it seemed that they had, but the problems came out with their operations, like their ability to meet Apple's demands with the volumes. Like they were constantly like rejecting material as not being good enough. And it got to the point that even though this was a debt-free company with a pretty strong balance sheet, the liabilities that were tied to its ability to meet Apple's contractually required demands were so onerous, management saw no other way than to file bankruptcy. It would have been nigh on impossible for most investors. The stock went from like $35 a share to $1 overnight. Like there were no signs that this was coming. So the wrong lesson to learn would be, well, never invest in an Apple supplier, right? And I mean, maybe there's some truth in like being mindful about like how leveraged is any company to an individual customer, right? Thinking about customer concentration is important. But the right lesson that I learned is you can't know everything.
Well, and the other right lesson is let that be such a small part of your portfolio that it doesn't bankrupt you, right? Like doesn't,
right? Right.
Exactly.
Yeah. There's the Buffett quote about, diversification being a hedge against ignorance. And it's a little bit of like a poke, like a little bit of a poke at like the average retail investor who has a diversified portfolio. But I think it's also like, look, know enough to be able to be concentrated into your best ideas, but position sizing is a great way to hedge against unknown risk, which is risk. That's all the risk is the unknown risk, right?
Yeah. I mean, there's 2 or 3 stocks in my portfolio right now that are down 70% plus.
Yeah.
And they are probably, that loss is covered by my 10th or 12th biggest winner.
Right.
Right. So, but that's a mental thing I think newer investors need to get over. Like having something go to zero or having something go down 90%. As long as there's enough other things that are up, it's that whole thing we've said before, like look at the total line on your brokerage statement at more than the individual lines.
Yeah, no, exactly right.
All right, here's a last one that we can talk through as we wrap up here. This is, I think, a big investing myth. I've fallen prey to this. Someone explained the math to me once, and it really kind of opened my eyes. So the idea that it can't get any worse, or it can only go up from here. So like the quick math is this: if you own a stock, it goes down 90%. And is now trading for $10. If it goes down to 1, guess what? It's lost another 90%.
90%.
Right. So, from that point. So
yeah.
I think it can't get any worse might be the 5 of the most dangerous words in investing.
Yeah.
And I more of a myth than a wrong lesson to learn. I'm sure there is a wrong lesson you can learn in there, but yeah, that is one where, or like reversion to the mean, or it has to come up from here. It can't get, all that is, nope, it can.
Yeah.
It can get worse.
I think any of these, however you want to describe them, tropes, myths about investing, wrong lessons, get tied to what the stock price can or cannot do, or should not do. Just put your fingers in. This works really well on podcasts. Putting my fingers in my ears. La, 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 la. Right.
Yeah.
Stay away because it's nonsense.
All right. I'm going to hedge a little bit and say, I do think if you are a knowledgeable person who, spends a lot of time thinking about this and like actually does the work, I think it's fair to say, I think it's unlikely that it gets much worse from here, or I don't think it will, but you better back that up with a reason. And you certainly should not speak in totality language, like it can't or won't.
Right. I think if you're looking to move forward with more investment in a stock that's fallen that much, the only real viable reason, in my view, is I understand the business and I am willing and I'm perfectly happy to pay this price because I think this price is going to look really, really good at some point in the future.
Because there are famous examples of very successful companies that have seen 70, 80, 90% drawdowns. Yeah. And there's somebody who bought at that point and is very happy now. So it's possible, but you better have a reason for paying that price and not just think you're paying it because it can't get any worse. That's my
Yeah.
point.
And here's another one. Here's another myth that people like to use. So they'll throw out, well, Netflix fell by 80% back in 2009, 2007, whatever. Look at how much Amazon fell back in whatever. Like they will throw out they'll cherry pick these. And we've done this, right? We've done this plenty of time, but we kind of back it up and say, look, the bottom line is that yes, great stocks fall by 20, 30, 40% from recent highs or more all the time. But you know why they do that, Jeff? All stocks fall by 20, 30, or 40% from recent highs or more all the time. It is a characteristic, it is a feature of stocks, right?
And the reason people point it out is not to justify buying at the bottom. It's to get people to not be shaken out of their positions when the market goes into downturn.
Yeah. Yeah. So, but if you just blindly buy that stock that's fallen under the false illusion that it can't get any worse from here,
It can.
It will.
It will.
It will. All right. I have another myth for you.
Go ahead.
I enjoyed this hour with you. I'm kidding. I really did. This is fun.
That's the perfect way to end the show.
All right. We're done. I have a better way to end it. As always, we love to share our interpretations of these investing myths, talk about our wrong lessons and the right lessons that we've tried to learn. These are our answers. These are our thoughts. It's up to each and every one of you to find your own answers to these questions about investing and life broadly. Learn better lessons in life, people. You'll probably be a better investor for that too. All right, Jeff, we'll see you next time.
See you next time.